Prashant Khemka joins us, founder with White Oak Capital. Let's connect with him to understand what his read of the market is, how he feels that the earnings season has transpired for his portfolio companies for the quarter gone by. Prashant, good morning. Thank you for joining us.
Good morning, Nikunj. Pleasure to
Let's
be here. Thanks for
let's
having me here.
first start with something simple. What is your current read of the market based on valuations and the earnings? Because even though earnings season was not wow, markets pretty much have digested it. On the banking front, NPAs went higher, markets are saying move forward. On the pharma front, margins were okay, markets are saying time to look forward. Do you think markets are running ahead of themselves or it's okay?
See, its conclusion, it's fine. It's okay. See, markets are interlinked all around the world. So the multiples of the valuations where we are in India are a function of where equity markets are globally. So it's not that markets only in India are trading near the high end of the long-term valuation multiples. But US itself, which is the ultimate benchmark in terms of equity markets, is trading towards the high end. And that in turn is benchmarked to the US long bond rate, which is what every asset in the world is eventually benchmarked against. And the US long bond rate is towards the very high end of its multiples, if you will. So the 10-year bond, if you were to take, is at 1.17% today, which was till mid-90s when I was studying there was at 7%. And before that, in mid-80s or early 80s was at 15%. So we've gone from a 15% long bond rate to 1.2% long bond rate, which in terms of multiples, if you were to invert them, would suggest that the bonds have gone from a 7 multiple to 80 multiple, right? And you have to keep the market multiples in that context. The US market's gone from maybe 15 multiple, which is where it was in the mid 90s, to 21, 22 multiple. I'm not suggesting they ought to go to 80, but you have to keep in context of where the bond markets are. And when it comes to the earnings in India and how the markets have reacted, so see, obviously markets are, while the analysts may talk about, this year's earnings and next year's earnings, or even this quarter's earnings and what impact it might have on the market, markets are in the end, and rightly so, a present value of future cash flows in perpetuity. So markets never move on this quarter or this year's changes in earnings unless those changes imply a structural change in longer term cash flows. But in this case, it is very evident to everyone that wave 2 is a one-off. Maybe there could be, there is risk of another wave, but it's not something that is structural, that there'll be wave after wave after wave into perpetuity. And this being a one-off, market is rightly ignoring the impact on the numbers from the 2 months of wave 2.
So Prashant, since the anchoring is centered around where the 10-year paper is, and that in a sense gives valuations for underlying P multiples, the valuations then some would imagine can be justified, because even if the 10-year paper or US 10-year paper goes to 2, US markets can justify a P multiple of 45-50, which means we still have a long way to go.
See, again, no one knows, and certainly I don't know what is the right justifiable multiple for a particular interest rate. What I was saying is, and what I am saying is, that when you think of a multiple moving from 15 to 22, you have to keep in context what the benchmark or other asset classes, most particularly the bond market, has done. It's like if you think of real estate in Bombay, and if you're comparing prices of Altamount and let's say Borivali, and the prices go up 50% at one place, you have to keep it in context of what the prices have done all around Bombay in terms of real estate. You cannot look at in isolation. So to your question of whether at a 2% bond yield, a 40-45 multiple be justified, I'm not saying that it can't be justified. I'm saying I just don't know. Let the market reach there. If market gets there, then maybe it is justified. It's just in nobody's realm of expertise to predict justify those, if you will, until the market justifies. What I'm saying is you can't expect to get logically expect to get the market at the same multiple today as it was as an average over the last 40 years, when the bond yields today are not at the average. Bond yields are at the lows. So how can you expect the market to be at the averages unless the future is really dire or has worsened tremendously, which is not the case.
Prashant, you've run a portfolio which in a sense has been centered around private banks, consumer companies, and they've done well because, let's say, last couple of years, the growth was very narrow and cyclicals and industrials were not doing well. So some of the stocks, fund managers like you, they bought for growth, some bought because there were no other options. But now growth is opening up. Now there are many more sectors, including commodities and capex dominated sectors, which are coming back. So what happens to your portfolio positioning when the options are plenty? I mean, one very famous market investor told me, yes, go ahead.
Let me clarify a few things. So the team runs the portfolio, one. Second, we do not run narrow portfolios at all. We are in fact at the other extreme. We get asked, and I've been asked all throughout my career, investment career, why we run such broad portfolios. And we go out of our way to ensure in our portfolios that we are not dependent on any particular theme or set of themes, leave alone a particular sector or set of sectors. So to your question, the portfolio that the team has been running for last several years is not focused on any particular sector and certainly not focused on financials. Having said that, yes, we've always found abundant, strong alpha opportunities in financial sector because there is a large number of very well-run private sector financials, which is where the team usually invests in. Furthermore, I would highlight that last 2 years have been very challenging for the financials. Even this year, financials year to date has been one of the worst performing sectors. And so was the case last year as well, when financials was one of the worst performing sectors, obviously because of the pandemic hit, which affects the financials more so than other sectors, right? So it is despite having the exposure that it has to financials that the team has performed as well as it has. And over time, there have been various sectors that have come into play and gone out of favor. The team has continued to manage a very broadly diversified portfolio that is built stock by stock, bottom-up perspective. So what happens to macro in a top-down perspective, be it at a market-wide level or be it at sectoral level, is highly, highly unlikely, going by past evidence, to affect the performance of the portfolio of the team. But what you are saying might be true for some of the other participants in the market who tend to have more narrowly defined sector-focused, top-down thematic funds and whatnot, that when a particular theme or sector goes out of favor, they might face challenges. But we have gone out of our way to minimize. You cannot eliminate this risk, but we have gone out of our way. The team has gone out of its way to minimize this risk, and not just this year, but it's been the case forever by design.
All right, so all about astute stock selection, consciously avoiding timing the market, etc. So right now, Prashant, where do you see the potential for alpha generation? I also want to talk about the new age internet companies that are taking Dalal Street by storm, if you could call it that, right? Zomato came in and just in a few days, it's managed to double money for its subscribers. We have a whole host of them entering Dalal Street in the next couple of months. How are you looking at them? Do you believe that this is one area that could generate alpha?
Absolutely, yes. So while we find opportunities across all sectors from a stock selection perspective and have in the portfolio almost every sector represented, barring some exception where we don't find alpha opportunities, to your specifically your question, where at this point in time we are finding more opportunities. So one that you just mentioned, new age technology, we do find many attractive opportunities. See, there are some that are listing right now, but there are some from the sector that have been listed for over a decade and have listed during the last decade. They might not be loss making, but they are new age technology companies, and they have been in the portfolio, and the team has done very well identifying the winners in that segment, and I'm quite confident they would going forward as well. Second, I would say what we were talking just earlier to Nikun's question, the team has always found a good number of great alpha generating opportunities in private financials, and I underline private financials, be it private sector banks or private sector non-banking financial companies or insurance companies or otherwise service providers to the financial sector. Third, we are finding and have found over time and continue to be the case right now, very attractive opportunities, underappreciated opportunities in IT services sector. So not the new age tech, but the traditional tech. And these continue to be amongst the fastest growing and lowest valuations in the market, both in large cap, but also particularly in mid cap IT services sector. And I think one of the key reasons I've often repeated is many people mistakenly have long believed IT sector to be a mature X growth sector. And the reason is they just focus on what companies and NASSCOM says about growth prospects in dollar terms, US dollar terms, rather than converting it into rupee terms. There is a 4% odd conversion, a depreciation of rupee that you have to factor in. So when NASSCOM and companies talk about 7 to 9% growth, it's actually 11 to 15% growth that it translates into in rupee terms, which makes it one of the fastest growing sectors in the market. And the valuations are not commensurate with them. These are highly cash generative companies, and we continue to find, and that's at the industry level. Some of the mid-cap companies that we own are growing at 15 to 20%, in fact, higher over the next 5 years, post the benefits of accelerated technology adoption after pandemic. And fourth segment, I would say, is we're benefiting from several China plus, if you will, China plus one opportunities, if you will, which is a real structural shift that started several years ago, not just post-pandemic. It started 5 to 7 years ago and could last over decades. And it's not necessarily focused on only one sector, but yes, in chemicals over the last several years, particularly specialty chemicals, it is where Indian companies have strong IP and engineering capabilities, and the shift is happening from China. There we found great winners, but also in some of the manufacturing related sectors, there have been great winners and continue to see the opportunities there.
Prashant, I want to take these sectors one by one. You mentioned IT, mid cap and large cap. Of course, they are not X growth. We're expecting to see strong growth over here. But my question is, most of these stocks have run up, more than 100% in the last 1 year. Don't you think the prospects of strong growth is priced into these counters? And if you feel they are, like you said, you feel that they are still a little undervalued, where do you see the correct valuations then for these counters?
So again, I want to emphasize this is not like a top-down sectoral call, but these are sectors where we still find a great number of opportunities that are undervalued for the growth prospects. So while overall as a sector, yes, over the last 1 year or 15 to 20 months, there has been some relative re-rating. But remember, the market itself is up more than 100% from the pandemic lows, and small caps particularly are up from the March 23rd low of last year's small cap, BSE small cap index is up more than 200%. And mid caps, which is what I was talking about, is up nearly 150%. So if some of these mid cap IT stocks are up 200% even, then relative to the market, they are up only, relative to the market mid cap, they're up only 33%. And all valuations, I repeat, are relative. There is no such thing as absolute value. And in that context, while there has been some re-rating if I were to broadly talk about IT services or even some of the companies that we own in the portfolio, I believe it's nothing compared to what there ought to be. There's a long, long way to go because to begin with, they were highly underappreciated. And while today there is greater appreciation of the growth prospects post-pandemic for IT companies, it's still not caught up with the structural long-term growth opportunity that these companies have ahead of themselves.
Sure. Prashant, I just want to get back to the point that you were earlier making. Given that Zomato has in some sense marked the FANG moment for India, there is also the other big debate on how to value these companies. They're loss-making right now. If you were to put precedent of an Amazon, for instance, it was loss-making for 10 years. But the other part of the market also believes that the valuations for these companies, because you have FANG as a precedent in front of you, is a little absurd. I mean, you have everything from a 40 range to 140 or 170 rather, that is being quoted for Zomato. Is valuation for these new age internet companies the right way at looking at investment?
So valuation, absolutely. For any investment you make, you have to look at valuation because no matter how good a company or business is, it is valued a certain amount. Nothing is valued infinite or indefinitely high sums of money. So valuation is extremely crucial leg of our investment process. And the same is applicable not only to traditional businesses, but also to new age businesses. Now, how you value is important. We, for one, never look at PE multiples, have never looked at PE multiples. We focus on cash flow based approach. So DCF value, and we have our own variant of it or a framework, which we call OpCo-FinCo framework. Now, one can argue DCF is garbage in, garbage out. You can make anything justify. Yes, but then it's the job of the investment team to make sure that they don't put garbage in, right? It's like DCF is a very powerful tool that, like any other powerful tool, can be dangerous in the hands of the unskilled, but can be very useful in the hands of the skilled person. So DCF would be the right approach to value this. So number one. Second, just because a company is making losses right now does not mean the present value of future cash flows is zero or negative. And you yourself gave examples of Amazon, and Amazon is a company I myself missed and has been one of the biggest learning lessons in my investing journey when in late 90s and 2000s. So for 8 years, from 98 to 2006, I was managing US money in US equities. While I got Google right and invested in it day one because it was profitable day one when it came IPO, missed out on Amazon all along because I felt like the business doesn't make sense. More volume they do, more losses they generate. But that was too myopic when I analyzed my thinking going back, that I was focused too much on just this year's and next year's cash flow. Even then I was focused on cash flow, but only on the near-term cash flow. What really mattered in the end game is cash flows in perpetuity or over the longer term. And that is how you'll have to look at these new age companies, even in India. I'm not saying everyone would be successful like an Amazon and everyone would make money and hence you have to invest in every company that's making losses. Remember, for every one Amazon, there are hundreds of companies in the US that went bust on whose name we do not recollect and hence don't even bring it up. But there would be selectively companies that would make huge amount of money. There'll be other companies that would make very strong and decent amount of money, and then be others that go bust. So selectivity would be of ultimate importance, even more so in new age companies. And hence we think it's a great area for alpha generation, because the greater the inefficiency and uncertainty, the greater the potential for alpha generation if you get it right.
That's quite interesting that you say that, but don't worry, even Buffett got into Apple pretty late and he regrets that too. But Prashant, since you're talking about your misses, considering everyone has their fair share of hits as well as misses, any other misses that you regret, a stock that you didn't get on in perhaps in time or completely missed?
Many of those, too many to really keep count of, and not appropriate to mention specific names I would say, in the Indian market context. But if I were to think of, a particular sector without saying name, I would say yes, consumer staples, which have been on a tear for the last 15 years, or at least since Lehman Brothers. Consumer staples has been one of the best performing sectors. And and from a valuation sensitivity perspective, even on a cash flow basis perspective, we've not been able to, or I personally, I would say, not been able to capture as many opportunities as could have. We certainly do have several names in the consumer staple sector. As I said, we do not ignore any particular sector, but from a valuation perspective, it was more challenging to invest in a lot many of those, and we ended up being too selective, if you will. And if I look back over the last 13, 14 years since Lehman times, I would say that would be one of the areas that I personally, and to some extent the team, also missed out on some of the opportunities.
Okay, that's an honest confession there. Prashant, great to have you on the show. Good chatting with you as always and gathering your insights.
My pleasure. Thank you, Nikunj, Aisha, and Mubani. Thank you for having me here.